signed up. We have about 20 on the call right now. So I am the chair of the Transaction and Business Development Committee. And the purpose of this is to highlight our various investment sales listings, and we'll do that in a minute. So if you can introduce yourselves in the chat room, and then at the end we'll ask people who want to volunteer information on the market, since we don't have that many listings we're going to go through. But first, let's talk about a couple things with CORFAC. So, leap year, February 29th, we have our spring conference in Dallas. So register, you'll see details coming soon. And again, you make deals with people you see, touch, and converse with. So I encourage everybody to go to this major meeting. We look forward. Next slide. Okay, this tool is underutilized in even my office, but we try to have some of our listings on it. And again, in all our proposals, we always brag about our national network and how we have national exposure to buyers and sellers. So again, we want to encourage people to use this sales platform. I'll take this as a hint, and Joshua in San Jose remind me that we want to get our listings on the CORFAC investment sales platform so that people can make use of it. Feel free to call if you need any information for getting on this website. And then you can see how various listings are on it now. You can share branded e-blast. When people search, that's one more web page that they can find. And again, the whole idea is how do we get more exposure, therefore the right price in these economic uncertain times. Next. Okay, first listing is Andrew or Mike in Houston there.
Yeah, we're here. Good morning. Good morning.
Just so you know, I have a sister that lives in Houston.
Well, there you go. Maybe she's a buyer. We'll pay you a commission if you bring her in.
Okay.
Andy and I've got a 385,000 square foot facility. It was built by Southern Glazers Wine and Spirits. They're the largest wine and spirit distributor in the United States. This was their original Houston distribution facility. They built Building 1 in 1980. They added to that Building 1 in 1992 or 1990, and then built this Building 2 in, I guess, 94. The buildings are 100% leased. Southwest Glazers Texas Operating Division is going to occupy Building 1, which is 267,000 square feet. The other building is 98,000 square feet. It's occupied by a local 3PL, Raynon. The deal here is they want to do effectively it'd be for their division, be a sale leaseback. They would occupy Building 1, 5 years lease from the time of closing. They're paying a below market rent, 33.4 cents. We think that market rent today would probably be at least 40 cents, and we're talking net rent per square foot per month. Raynon is in there at 36 cents. They're leasing 88,054 square feet. Anyway, what we're looking at is a deal that's probably going to be priced, when you look at a sale price, it's probably going to be in the mid $50 per square foot range. The majority of the space has, the Building 2's 30-foot clear tilt wall, ESFR sprinkler system, which is being upgraded now from a ELO system. Phase 2 of the Building 1 is about 98,000 or 93,000 square feet, 30-foot clear tilt wall, ESFR sprinklers. Building 1, partially ESFR, partially standard sprinkler system. Clear height there, 17 to 30 feet, and the Building 2 and the second phase of Building 1 is 30-foot clear. Limitations, it's a little bit crowded on the land. And it's limited as far as the number of truck doors. But you're looking at a deal. We think we're going to plan to put it on market here in about 2 weeks. We wanted to just introduce you guys to it. they recently acquired, you'll see that's called a shop building. That's a 22,000 foot building that's not included in the square footage because of its age and condition. It needs to be reskinned basically, but it's sprinkler, 18-foot clear height metal shop building on 2.3 acres.
Yeah, but the advantage of the shop building is it's got about a little less than 2.5 acres, all of which is stabilized and provides additional truck parking or outside storage. It is not leased. We believe there's value add in being able for a new owner to lease that to someone and get a little kick in the annual income. And we believe, as Mike said, both of these rents in building 1 and building 2 are below market. They probably are maybe 15% below market.
The building price is far below reproduction cost. The net income right now would be about $1,532,000 a year. It's landlord's got some structural maintenance, but other than that, it's their net leases. And there is the building 1's rent will go up. Under their current lease situation, it'll go up by the date of closing, and to bring the total net income to about $1,570,000. So we're thinking that it's going to be priced in or we think a sales target price is going to be the low 20 million. That gives you about $54, $55 a square foot.
That's between a 7 and a 7.5 cap.
Yeah, on it. So questions?
Questions, anybody, before I ask a question? So one question is, if the 3-year lease tenant were to leave, how strong, or, it's obviously 3 years away, so maybe a better time, but what's the release period if they were to leave?
We think that's the most leasable. I mean, that's the most functional building. It's 30-foot clear, ESFR sprinkler. It's got an abundant of. It's got about it's got 2-story office, 8,000 square feet on each floor, and it's got recessed truck loading. It's adjacent to that shop building, so you could have an extra, couple of acres outside for storage. We think it's highly desirable if the current tenant does not renew the lease.
We think that
the tenant has a 4-year renewal option, but doesn't mean they're going to exercise.
And if that renewal option's at a 3% increase or market, whichever is higher, and we're confident market's going to be, well, market is already higher than the 3% increase for what they'll be paying at the end. So
the other relevant issue related to desirability, we don't have a map on this particular slide, but you can see the proximity to downtown Houston, NRG Stadium, the Galleria. This is clearly a very much an infill location to the city. It's like it's about 5 miles from the central business district.
Also it's less than a mile Loop 610 there in the distance, and both the streets it's in a deed restricted business park. There are 2 main streets that don't show here that run north-south. Both have 4-way intersections onto the south loop. Coca-Cola is our neighbor to the left. Ozarka Water is neighbor to the right. Texas Medical Center owns the building just north of us. So we got some good neighbors. It's a good infill location. And right now we're having good leasing activity, although our vacancy rate in the city is probably up 5.5% right now, but there's good demand in the 100,000 foot spaces and lower. So, what it'll be in 2 to 6 years, not sure, but we're optimistic that we can release it given its infill location.
Very good. Any other questions before we move to the next? Good luck. Next slide.
Thanks.
Okay, John, introduce yourself.
Yeah, this is John Cavan calling from Nashville, my first investment call. So I'm getting used to the Zoom system and everything. So so I thought I would put this out there. It's a metal building located on a main street in Nashville. It's two buildings, 17,000 and 3,000 square feet. So it's a little over 20,000 square feet. And it could either be industrial or retail. It was built as a tractor supply store originally, and it was built in the 80s. It has been reoccupied by a tenant that sells building supplies, basically, with a new 5-year lease. And so it's for sale at a 6.57 cap rate. Nashville has very few investment properties, industrial, retail, or otherwise. And so that's what I've got.
Well, welcome to the team, and any questions? Too technical. What's the age of the roof, and is it sprinklered?
It is not sprinklers. It is it's got a new roof with a 20-year warranty. It was put on in 2018. New sealed parking lot, 14-foot clear height. But it's an older 1980s building, so it is not sprinkled. Current tenant doesn't need that, but you know, it is a downside long term.
Very good. Then is that an industrial site to the right of it?
It's a gas station.
Oh.
It sits on a corner on a main north-south corridor in Nashville.
Very good. Any questions, anybody? Good luck.
Is that on the market? Is that actively on the market now?
Yes, it is.
And what kind of activity do you have?
When it was vacant, we had quite a bit of activity, but now it's got a 5-year lease, and we haven't had a whole lot of activity on it, to be honest with you.
I'm sorry, say that again. You've had a lot or not a lot?
Not a lot lately, and part of the reason is it's not triple net. The landlord still pays the property taxes, but I think we may be able to restructure that. I think the tenant would be open to make it a triple net lease, which would, if I can make it a triple net lease, it'll probably sell quickly.
Okay. Very good. Hey, good luck. Next slide. Okay, Philippe.
I'm Philippe Geurden from Orion Properties. We're based in Belgium. And this is a new development of a Belgian developer in Spain. Close to it's called the Costa de Luz, and touches the Atlantic Ocean. It's got more and more. It's gaining more and more interest from investors because there's actually a lot to do. For instance, from February till March, you get this international horse competition, affecting 2,000 plus 2,000 horses and their teams. So construction will start this month. I think they just about started. So the promoter is looking for an institutional investor. We're looking at a target sale of 50 million. Actually, it's 47.5 million. And they've got a lot of how do you call it? People willing to operators. So, but he hasn't signed a deal yet because it depends. We advise them to not sign a deal yet with an operator because it depends on which on the investor, which kind of operator he wants. To give you an example, he's got one operator who is willing to pay a lease 10 to 15 years, giving a yield of 6%. He's got another operator, based in Spain, with a lot of hotels under management, and they're willing to sign a management contract. In that case, the lease would be less, but the investor would take a bit from the profit. And in that case, we're looking worst case scenario at 13% yield, the best case scenario 16%. It's 18,700, let's say 50 square meters of built area. That's more or less 60,000 square feet. 181 keys, which means 163 apartments and 18 shops. At the moment, he has sold 25% to separate retail investors. But if an institutional investor would like to have 100% of the building, that's possible. Then he will give the early birds a bonus and buy everything back. That's more or less everything I have to say about this property.
Does the sunset come with the opportunity?
Yes, I do believe so. Yes. It's from the view from the beach where it will be built. So it's a seafront development with also 3 pools close to the marina on the one side and to a natural reserve on the other side, and next to the local promenade. So it's got everything going for it. It will be a 4-star resort, the first one in the area. And to give you an idea, all the horsemen who gather there in the winter, they go to neighboring villages at the moment to just have a 4 or 5-star resort or a hotel. So it looks very good.
I'm curious, is the beach rights country, or does it come with the resort? They own it?
No, they don't own the beach. No. But it's a very, very wide beach. Yeah, it's gonna be. I can show some pictures, but it's pretty close. Or yeah, it's actually in the center of of Barbate. So yeah, that's about it.
Very good. Any other questions, anybody? You have to go visit this.
Yes, if you find the seller, maybe the CORFAC meeting should be there next year.
Very good. Good luck. Next slide. Okay, so Josh is going to take this one.
So this is me. Welcome, CORFAC Investment Nation. I've teamed up with your favorite tech guy, Phil Tomlinson and Eric Butler, to bring a QSR brand new Chipotle that is located in Queens Creek, Arizona. We have priced this at a 4.6 cap, which is consistent with other brand new Chipotles that are currently on the market. This property was completed in the end of 2022. It was a 15-year triple net lease with 10% increases every 5 years. There are 4 5-year options, all with the 10% bumps. The income started January of this year, so we've seen 11 months of income on this property. Chipotle, one of the stronger new tenants that are active in the market with new locations. This is their lane drive-through facility. They currently operate 3,283 stores in the United States and abroad. And they are obviously a strong credit with $7 billion of revenue. This is an out parcel located in a Safeway shopping center at the intersection of Ocotillo and Ironwood, which is, again, Phil's not on the call, but to quote Chris Farley, you know, I can take a good look at a T-bone by sticking my head up a bleeps, but I'd rather take the butcher's advice. So if you have any questions about this area, please refer them to Phil. But from what I understand, this is a main brand new development brand new homes. And again, this intersection has all the national tenants. You have the other fast foods that are there. Again, this property priced at a 4.6 cap. You have 140,000 NOI. Seller wants to sell it since he's a California owner, doesn't want to go and travel. He's a guy that goes up and down the state looking at his properties and doesn't want to continue having to go out to Arizona. So we've teamed up. We'd love to have a year-end close on this. Also, any California buyers or other states that have a high income tax, state income tax, the state income tax for Arizona, not as good as Jeffrey West's 0%. However, it's a 2.5 flat rate in Arizona for state income tax. So if there's any other questions, please let me know. But this is a QSR brand new triple net investment deal.
Very good. Any questions? So this is one of the few investments under a 5 cap.
Correct.
Okay, next slide. Good luck and say hi to Phil and next slide.
I will. Thank you.
Okay, John and Adam.
Hello, can you hear me?
Yes.
Great. Now you can't see me, I guess, but I did turn my video on, so it's not my fault. This has been available. We did adjust the pricing, so it's more getting closer to where it might trade at. This is a recently extended tractor supply located outside of the Washington, D.C. area in the eastern panhandle of West Virginia, which is a growing area, doing very well. It's a pretty straightforward tractor deal with 5% bumps every 5 years. Those used to be 10, but we had to negotiate those down for the early extension. It's got allegedly strong sales. It's just a great location for tractors. So if you have any buyers that are interested in this tenant who's done very well nationally, it's been a good stock to own. They don't have a national direct competitor. So it's a company that's done well and a tenant that does well. It's a more of a double net lease with the landlord responsible for roof structure parking.
What kind of cap rate is that on that income?
5.75. So this kind of tractor would have traded closer to a 5 cap not that long ago, but as we all know what's happening. So and it may not, it's been available. It's a tough time out there right now for some of these assets. So but we've had offers in the lower 6s, so we're getting there. We might be getting closer.
Any questions, anybody? Well, good luck.
Yeah.
Next. Okay, Beth in Dallas. Is Beth there?
Yes, Beth is here. Technically challenged, but I'm here. So I'm Beth Fenton with Bradford, and I'm in Dallas. And I just wanted to cover a little bit about our opportunity fund. We've extended the fund to February. And here are some recent wins up here. Oh, you may not see my pointing, but my goal is $10 million. This is our third fund. The first fund is our Bradford building, which is 97% occupied. And we really focus on the decision maker housing. And so we're having great success. So this is our third fund. The investment size is 25,000 minimum. I'm getting the 100, the 500, and hopefully a couple millions. But those 25, 35 doesn't add up, and that allows our brokers and myself to get in the fund. Kevin puts in 1%. Let's see the location. Oh, we're going to have 1 to 2 office buildings, and we have the ability to close the fund if we find a building before February. It'd be 15% underwritten, targeted annual return of 20%, and there's no upfront fees. We're pari passu up to 15%, and then a 50-50 split. And then if anyone doesn't know, Bradford's been owned by Kevin since 2000. We also have property and construction. And then I focus on raising money for the opportunity funds. And we've leased and sold 15 million square feet, and we do 500 transactions a year. So past successes that are noted here, if you can read that, in 3 different properties, this is a big one with Daniel Dale, was 57% IRR. So I'm looking for investors. I mentioned quickly a building that we had on our last meeting, and we've been back and forth with a building that is called Bent Tree Green. It's on the toll road. It backs up to a country club. We're retrading with them and deciding if that's the asset that we'll get, and put that in the fund, or Kevin's always on the lookout for another property. So that's what I'm doing, is raising money for investments in office.
So that's very interesting. So is most of the portfolio office buildings?
Yes, this industrial is there from last fund.
And then just curious, since the joke in my office is I want to trade 3 office brokers for 1 industrial, because the office market is not doing so well. But
Really?
in our top markets, we're at 25% vacant, California. So what's the vacancy rate in Dallas and Texas?
Just got that the other day. But let me get back to you on that, because I don't want to misquote. But we're just buying 1 building. That's what I'm out there telling everybody, is we're not buying downtown. We're not buying Las Colinas. We're not buying where there's 3 floors of Chase building and they decide to pull out. These are engineers. These are professional CPAs, wealth management firms, engineering firms. These are the people that are in the building. So we've done really good with our buildings called Meadow Park Tower.
Okay. Are most of the buildings in Texas?
Yes, I'm sorry, DFW focus for sure.
Good questions, anybody?
Thank you for this opportunity.
You're welcome. Any questions? Okay, so we have some time. Oh, next one. We have a new one. Oh, from the Netherlands is it from
That's me, I think.
Oh, Mark,
Yes.
go ahead.
That's good evening here from Amsterdam, the Netherlands. Happy to join you, of course. Was a little bit late, but happy to pitch this residential property investment in the city of Zoetermeer in the province of South Holland in the Netherlands. It's an off-market exclusive investment proposition. We're not sending it onto the market in the Netherlands, but I'm happy to share it with you. Price range, it's a residential investment of 80 social rented out small apartments, studios. There's no asking price, but the target price range is around 8.5 million euros. So the cap rate based on the current rent is now 413,000 euros a year. So that will be a little bit less than 5% cap rate. But the seller has already done some investments in sustainability, and he has a plan to invest 350,000 euros more. And that will result in a higher rental potential of approximately 600,000 euros per year, resulting on a cap rate of approximately 7%. So the building in total is around a little bit more than 1,700 square meters. The opportunity is core. That's what I just mentioned, a value add component. The seller is a Dutch investor, developer, who will now is planning to do some asset rotation to invest the money which it brings up in new properties and the current portfolio. This kind of investment in the Netherlands are a little bit rare. So yeah, again, I'm happy to share this with you.
Very good. So social units, those are affordable housing in our.
That's correct. Yes, it's affordable housing. Yeah, we call it social housing in the Netherlands. We have 3 layers, let's say, by law. That's social housing. That's the mid rental and the free liberalized rental apartments. So this is affordable housing, what you just mentioned. And the downside of this investment is very low because it's all regulated by law.
So that was my next question. So the rates are regulated. You just can't raise the rental rates. There's a period of time for the rental rates.
No, we work here in the Netherlands with a point system. So we have a schedule which you earn as a investor in residential points for, let's say, for example, square meters, sustainability, outside space. That all will accumulate in points. And regarding the amount of points, there is a price tag regarding rent. So if you do these investments which the seller is planning, you get a possibility to get more rent by mutation of the tenants. So the tenant mutation rate of this complex is 20% a year. So in 5 years, it will be mutated, and you have in 5 years the possibility to upscale the rents.
Like carbon offsets, is there a side market for those points?
What do you mean exactly? I'm sorry.
I mean, in carbon offsets, there's a third market where you can trade your carbon offset points. Can you trade these offset points on social housing units?
No, that's not. Unfortunately, that's not possible in the Netherlands. I know what you mean, but that's in Holland. It's not possible. Not yet.
Interesting. Questions, anybody? Okay. Are there any more investments, or we're going to go to open forum? Okay, so we have some time to talk about investments that you weren't able to get on the template. One listing that I and John Sexer did not put on because we had 22 acres of commercial retail hotel land in Brentwood in the East Bay, east of San Francisco, but we are putting it in 10X CoStar auction today and yesterday. So we have a couple bids. It's land, not entitled, land that is zoned near some big boxes and new housing areas. So I'll let everybody know how the 10X experiment is working, where you actually have a live auction online. Has anybody else used the 10X option in the United States?
Josh and I did on the Taco Bell in
Yes.
Midland, as well as we did, a standard marketing process on that both before and after, and we came within 25 grand,
Something like that. Yeah,
of it trading. I mean, not to bring up bad stories, but yeah, we were 25 grand away from it trading on that platform. We had good engagement. We had, I've had some experience with that platform also when I was with Cushman and CB with 10X and then its predecessor, auction.com. And it's hard for assets that have a lot of hair on them, a lot of due diligence risk, things like that. It's great for coupon clippers. It's great for, cookie cutter kind of deals where people don't have that risk and it's more homogenous and they can kind of digest it, a lot more readily, because you're asking someone to invest time on due diligence and give deal certainty without control. And most people aren't going to do that if there's a deep dive on the due diligence side.
That's our experience. I mean, we've had the land during COVID and this cycle on the market for at least 2.5 years now. We've had a previous escrow. And since it's land not entitled, to your point, due diligence is tougher.
Mhm.
Anybody else have a listing they want to describe that didn't make the template? Anyone have a market comment? Are we all cheerful that the interest rates are going to continue to go down and cap rates will go down in June 5th next year? Or is it going to go the entire year, stay where they are? Come on, brokers have to give projections. I'm gonna call on somebody. What's San Jose doing, Josh?
We're still, everything is a 5+ cap unless it's like what I'm trying to sell here, sub 5 because of the area, the growth in this Queens Creek, Arizona area. It's funny because I actually have another client who I was coincidentally talking to, and she made a comment, I'm real bullish on Arizona. I said, oh, what do you have? She says, I have a Chipotle in Queens Creek. And I said, so do I, but I'm selling it. She said, we're still in the high 4 cap rate range. However, everything else, I just saw a Chick-fil-A today at a 4 cap. It's really predicated on location. My deal is really geared for a trade buyer who just has to place some money on a solid investment that he's not concerned about credit of the tenant. So, but everything else, you're still above 5 and higher that you're not going to get financing to make it make sense. So it's just tough.
So is there, the Bay Area in transactions is relatively slow, like most people. Is there any metro to the people on this call that's bucking the trend and people are migrating there to invest? So is Houston the same low velocity market, or is it more active?
Houston has been pretty active. And again, it gets down to the quality of the product. Cap rates have risen with interest rates and we never got as low a cap rate as you got in California. So.
Yeah, our cap rate, go ahead.
No, we're just to follow Mike's point, we've still seen deal velocity, and yeah, cap rates are up from where they were a year ago by, depending on the asset, 100 to 200 basis points, but they're still trading. Texas is a desirable state still.
No income tax.
So as a counter, San Francisco, which was selling Class A office buildings as late as 2018 at 1,000 to 1,200 a foot, are recording sales at 200 a foot. And we're experiencing once a week, at least a major institution, Brookfields or equivalents, walking away from their buildings. They don't have recourse. And so the insurance companies and the REITs are becoming landlords in our market. And that's going to interesting dynamic. How does somebody based in Iowa know what to do in Oakland and San Francisco? So our market is going through that. The average vacancies in office are 25% and higher in Oakland and San Francisco, as much as 30. We do have amount of sublease space out there. A building recently traded near Walnut Creek that in 1985, I sold the land to Tishman. We had rents of $36.85. It's sold for $350 a foot as late as 19, and somebody just bought it for $120 a foot. So meanwhile, industrial is still around a 5 to a 6 cap rate, depending upon the tenant. Retail, depending upon where it is, and multifamily is soft. How about another market? How's Toronto doing, Ray?
Here, okay. Yeah, the higher interest rates are having certainly a significant impact. Like the US, they doubled. Industrial, you're 5.5 to 6% cap. But those are from the larger institutional players, because just to go out and borrow today, you're going to be paying about 7% interest rate on the mortgage. So on industrial office, I think we're about 18% vacant downtown. The gold prime office buildings are doing okay, but everything below that is getting shaken out a bit. Just heard of one deal downtown where the landlord gave a long-term lease at 0 net effective rent, just to figure this market wasn't going to come back for a while and just didn't want to pay the carrying costs on the operating costs in the building.
Interesting. Another indication of how soft the office market is, if you ever been to San Francisco,
Wow.
if you come across the bridge, you see buildings on your left in Emeryville, there's 1 million square feet, about 35% vacant. I just went to a broker open house where if you just showed up, you got 150 in cash. So and then if you're leasing, they're paying brokers $3 a foot for the first 5 years, even if it's half rent. Anybody else?
And I just want to comment, I have a property in Menlo Park. It's a sublease space. And we're offering a $200 gift card to a broker for tours. So
Wow.
the client realizes the market is that bad, and just to try to incentivize a broker to get his people in the building, as long as I show up, they get a $200 gift card. So I know who wants to come down to Menlo Park.
By the way, that's the center of Silicon Valley, so interesting. Anybody else?
I wanted to see if we could talk, I'm looking at some stuff now. I'm looking forward on trying to find motivated sellers and deals that are, they're going to have a need to trade, and doing some just cursory analysis on the debt market as far as loans that are maturing in 24, maybe even early 25. And one thing I'm noticing, I don't know if anybody else has gotten into that deep dive yet, is because of the vintage of when those loans were issued, the underwriting was pretty conservative. So there actually isn't as much refinance risk there as we maybe were all hoping there would be, and seeing deals where they're probably 50% on loan per square foot of what the current value is, even at an elevated cap rate. So a deal you're underwriting to maybe a 7.5 cap on current market rents, that there's enough space for someone to refi there. There's maybe not as much going to be as much distress as we were hoping. Obviously, trophy assets, you're seeing it in major metros, LA giving back assets like you talked about, San Francisco with trophy assets going back, things like that. But on that more mid-market private capital sector, it seems like we're now, the owners are benefiting from that conservative underwriting that was, being utilized in 2013, 2014, 2015, post-Great Recession. So we're now not seeing, and again, that's just a cursory, not a deep dive on everything, but just a quick sampling for a few different clients where I was doing that research. Has anybody else gotten into that analysis yet to see kind of where they see that pipeline of distressed debt?
Good question. Any thoughts on that? One thing we're seeing, by the way, because of remote and some other things, flight to quality. So tenants for the top of some buildings will pay $60 to $70. Meanwhile, the second floor might be 30. And then the other market that's still active, meaning it has a pulse, is small building sales. So in the same markets where big buildings go for 200 a foot, we see 10,000 foot buildings going for 500 a foot. So even at SBA loan rates of a 7.5, 8 blended, users are still buying their buildings. Not as active as 5 years ago, but there's still pulse in that market.
Well, we have that here. There's a deal I'm taking out right now that we represent the buyer on just a little over a year ago at a 5.5 cap, 300 a foot. Tenant didn't end up doing their extension, so we're going to now take it out to a user market at 380 a foot. Tenant has 100 a foot invested in TIs, so there's a great value add story, for that next user coming in. But obviously, on the investment side, that deal would not, it would trade at probably a 6.5, 7 cap now, with where things shifted. Even if you're able to re-tenant to back to a single tenant status. So the better exit there is the user sale, and it'll probably pop $2 million profit for the owner in a declining market. So
interesting. Anybody else? Another trend we're seeing, so you pick on big names, so a Brookfield or another equivalent tenant will give back a building in one market and then raise a fund to buy buildings at a third of the cost in an adjoining market. And so you just have to keep in touch. I'm representing a 70,000-foot medical tenant in Oakland and being treated like royalty. And in one of the questions in our RFP, we asked for the debt and the existing loan on the ownership to make sure they're there in 5 years. So that's a new thing that we're doing in our RFPs for leasing. Anybody else? Come on, there's other markets. Patricia, what are you doing? Even though I can't see you. Robert, I can see you, so I'm going to call on you. What's your market? You can't hear you. You're on mute.
There we go. Phoenix, Arizona.
How's Phoenix doing?
Phoenix, the industrial market seems to be holding up okay. We have a whole bunch of new product coming online though. So down the road, we're wondering what's going to happen. Thing in industrial in Phoenix that's really had a big impact is the Taiwan Semiconductor in the Northwest Valley. Intel has done major expansions. The EV market down in the South Valley, south of Phoenix, both battery and vehicle manufacturing have been huge expansions in job growth in Phoenix. So our industrial market has held up very, very well. The office market, very much like what we've heard right now, is not doing that well. I have one sub-market that I have some product in right now that is sitting at about 12%. And that's just because of some redevelopment area. A lot of buildings have been purchased to demolish and redevelop in that one sub-market. But valley-wide, we're probably closer to 20% right now in the office market.
Patrick, how's your market?
Well, hey, Ed, one sec. Robert, can you comment on Queens Creek? You're an Arizona guy. What do you think about it?
I don't spend a lot of time in Queen Creek. That's in the far southwest valley, and I'm in the far north. You're in the far southeast valley, and I'm in the far northwest valley, about 65 miles away.
Okay.
But the growth down in that area is off the charts. The Pinal County to the south is growing like gangbusters because that's where the land is for future development. Right now, the infill sites have pretty much been used up. There's absolutely zero industrial dirt around. If you can find it, you're going to be looking at $25 a square foot plus just for the dirt, which is a big number for Phoenix.
Thank you. Again, local 60 miles is better than where I'm at in San Jose. So thank you.
Understood. Understood.
Patrick,
you know, I will have a side note is I did have a developer I was working with some 1031 money that needed to place. And I would say developer, and he chose to go to Yuma, Arizona, which is over on the California-Mexico border. And right now we're planning about 600,000 square feet of industrial space there. So it'll be interesting to see. It's a great site though, right along the Interstate 8 with good identity. And we can deliver space for 30,000 square feet on up to 400,000.
Wow. Okay, Patrick.
Thank you. Yeah, I'd say it's very similar within the office market. Some of the things that you guys expressed, I'm seeing a lot of parallel in the San Antonio market. I will say with the industrial market, it's remained somewhat strong given that some of these, Silicon Valley techs and warehousing logistical companies are transitioning to the Austin, San Antonio region, that I-35 corridor. So I've seen quite a few projects come on the line. I'm just wanting to see how absorption will play out over the next year or so. And while I'm speaking, I'd like to introduce myself as well. Endura Advisory Group just became one of the newest CORFAC members.
Welcome.
And so thank you. We're down here in San Antonio, and I look forward to connecting with you all. I'm mostly focused on land development for multifamily, single family, and industrial, as well as a little bit of tenant rep leasing. So I've been in this game for only a year and about 2 months, and so I'm learning the ways, and I hope to connect with you all some way, somehow. Thank you.
There's some other trends. Another trend in our suburban market of the East Bay office that may be similar in other markets. People are starting to brag they're up to 50% occupancy with people showing up. I only get 50% when I offer food, alcohol, and money to my brokers. Otherwise, it's less. But in the here's a stat for the East Bay. If we settle in at 65, 70% back to work in the East Bay alone, that contributes 15 million vacant more square feet to the market. And that's one reason why we use numbers like 10 years supply of office space. So it's suburban office values, unless it's a long-term medical tenant, are just down. And the conversions are more of a chimera than they are real. It's really the old B and C buildings that can be converted with shallow bay depths to residential. But the office buildings, you can't core a 20-story office building. Although there's something interesting. I don't know if Jamestown is in any of your markets. Jamestown walked away from an office building in San Francisco. They own a major building in Concord, 300,000 feet, a data center tech that's built like a bunker. 4 stories. B of A left it and shrank just this last year. And they're thinking of converting it near one of the BART stations to a 4-story advanced food production building. It has 60,000 foot floor plates, but plenty of water, plenty of power. So be interesting deals as some of these buildings, what you do with them. Anybody else? We have time for one more before we do a commercial. Okay. John's not moving, so I can't. Joey, you're moving. You're live. Anything from your market? Did I say your name right? Boston? Biotech, life science? No. Anybody else? Okay, reminder, February 29th in Dallas. So Patrick, we're going to see you in Dallas. So welcome all the new people. Encourage you to get your investments on the platform and see everybody in Dallas. Have a good day.
Thanks, Ed.
Thank you very much all. Have a
Thank
pleasant
you.
day. Bye-bye.